This is the Average Guy Network, and you have found Financial Tech in the Guide Rock Capital Management Weekly Commentary for the week of July 15th, 2013. I'm your host, Jim Collison, broadcasting live from the AverageGuy.tv studios here in Bellevue, Nebraska. And of course, we post the show each week, including the written commentary from Andrew, out at the AverageGuy.tv. Financial Tech brings you the latest market commentary from the award-winning Andrew Hunt, CFP and president of Guide Rock Capital Management, located right here in Omaha, Nebraska. If you'd like to receive a free copy of the written commentary in advance, send us an email. Just send that over to Andrew, actually. Andrew_Hunt at GuideRockCapital.com. Put subscribe in the subject line. He will get you signed up so that comes each and every week automatically to you. If you have questions or comments that we can read and answer on the show, send us an email. Send that again over to Andrew, Andrew_Hunt at GuideRockCapital.com. And of course, you can find both of us on Twitter. Andrew is at Andrew D. Hunt, and I am at Jay Collison. Andrew, great to see you this week. I know you were not around for the weekend. We missed you, but great to see you.
Yeah, glad to be seen. Glad to be seen. I can tell we're experiencing a little bit of latency here, Jim, just for the record, so that you know. But yeah, unfortunately, I was on the road. I was down south. I was in Tulsa, Oklahoma this last weekend, seeing some family. So it was good, but I'm glad to be back. If I may entertain you with a bit of a tune. Which one of these is not like the other? There you go. Andrew Hunt doing song. But if you find yourself humming that old Sesame Street standard, especially when you think about the markets and world economies, you are probably not alone. To the consternation of many, the Dow Jones Industrials Average and the S&P 500 index rocketed to new highs last week, just as the International Monetary Fund cut its global economic forecast for 2013 and 2014. Many in the media pointed fingers and announced, that's the problem right there. And of course, they were pointing at Ben Bernanke with the Federal Reserve, which just continued to dither about quantitative easing last week. While it might feel good to lay blame, the Fed is just one tree in the forest of market volatility and economic growth. So let's take a look at another sector of the forest, emerging markets. They are expected to power 60% of the world's economic activity by 2030. Yet just last week, China's exports slumped, and Brazilian and Indonesian central banks raised interest rate, which generally slows growth. Turkey's central bank may do the same next week. And so is slowing growth in the emerging markets the Fed's fault as well? It's kind of interesting. While higher rates in the U.S. may hurt emerging markets, many of those countries have problems of their own, including infrastructure bottlenecks, excessive credit expansion, and so on. Last March, the Financial Times quoted Deutsche Bank strategist John Paul Smith, who wrote, quote, "We believe that 2013 will mark the year when economists and investors focus on the underlying imbalances within the Chinese economy and accordingly reduce their expectations of sustainable growth over the medium term. The deterioration of the perception of China is likely to have a very disruptive effect on global emerging market equities." Well, end quote, Smith's forecast proved out. Early last week, the International Monetary Fund lowered expectations for China's growth to the 7% range, which we've talked about China on this show before, and so that's actually even lower than some of the old statistics we've talked about. Of course, it's not easy to predict the future. Irrefutable evidence of that arrived a few days after the IMF's report when Liu Jie, China's Minister of Finance, said his country's growth rate could fall to 7% or even lower. And of course, all the economists totally gasped at that point. China's official growth target, which is set by the National Congress, is 7.5%, not that 7.0% or lower. According to the Wall Street Journal, quote, "Such a sharp downshift in China's growth could send ripples around the world economy, hitting everything from iron ore demand in Australia to sales of luxury handbags in Hong Kong stores," end quote. So a lot to watch there. It'd be pretty interesting to keep an eye on that. So let's switch gears here a little bit. So it's pretty clear that in America, people are still pulling themselves up by their bootstraps. 3/4 of all the folks who participated in the 2013 U.S. Trust Insights on Wealth and Worth survey, which is made up of all people who have $3 million or more in investable assets, made their money the old-fashioned way. They worked, owned a business, or invested. 3/4 of the people that participated in that survey. Most of those people believe they're financially secure and feel confident about the future. Well, that proved true for many aspects of financial planning. The study uncovered some unrecognized risks, many of which have been created by a volatile investment environment and changing tax laws. And so those 4 risks I'm gonna share with you guys tonight. The first one, complete retirement planning. Although the vast majority of those surveyed are very confident about having the income they need during retirement, many have overlooked factors which affect income and assets, such as lifestyle expectations, out-of-pocket healthcare expenses, and long-term care costs. Those things can really blow up your plan. The second piece that they neglected to recognize is maybe financial support for extended family. Almost 1/2 of those surveyed provide significant support to members of their extended family, which could include parents, in-laws, siblings, grown children, and so on. However, the majority have not included that in their financial plans, which could blow things up pretty quick. The third thing is conflicting emotions about investing. And this was really interesting to me because of my work around behavioral finance, but this one was interesting. The majority of those surveyed said growing assets is more important than preserving them today. However, they also said lowering risk is a higher priority than pursuing higher returns. No, that's just backwards. If we sit and think about it, that's conflicting statements. Very, very interesting stuff. And then the fourth thing was tax law changes. A majority of wealthy people do not understand the ways in which tax law changes may affect their income. It can affect their investments and their estates, and very few understand the tax strategies which might be available to them. So 4 things that those wealthy need to look out for. To me, that says job security. Okay, so here's the quote of the week. It's from Benjamin Franklin. Tell me and I forget. Teach me and I remember. Involve me and I learn.
Yeah, that's a great quote. This weekend, as I've been doing some work here at the Collison house, we got outside and I needed some concrete stumps or concrete footings dug out. Brought my boys over, my older boys, and we involved them in that process, and they learned how to get those out. And so that's a great quote indeed. Andrew, let me ask you one question. The very first is in the second section, as you were talking about people feeling secure and confident about the future, and you mentioned a lot of folks they have an incomplete retirement planning. What's the typical planning process time? If somebody comes in kind of cold and they haven't thought through it, what would they expect if they were to work with somebody like you as far as getting ramped up in getting a complete plan?
Yeah, good question. So I should first clarify. So financial planning is a process. A lot of times people might think of a plan as a document or a book that they get from a guy like myself. I don't necessarily agree with that. I'll give you a book, but I believe it's a process that goes on for life. But typically the way those engagements work is you start out with 3 or 4 hours of discovery and comparing notes and getting documents together and all that kind of stuff, and we hold our clients' hands through that process and identifying. The second step would then be identifying the issues and figuring out what it is you're trying to answer, defining the scope, and then we go away, do some analysis, and we come back and make some recommendations and then implement some ongoing monitoring procedures to help people down the path. And so, you're probably looking at 4 or 5 hours up front, and then 3 or 4 hours during the recommendation and setup session. So maybe 7 hours total.
And what do you expect from a person? They've got to certainly go back and maybe dig into their own little finances a little bit. Maybe an hour or so worth of work there, homework, to kind of bring in.
Yeah, it's pretty light. I encourage people. We do have a questionnaire that we send out, and I say, hey, 25, 30 minutes max. Don't spend much more time than that on this questionnaire. I might give you some homework and say, hey, go pull these statements to look at some investments and things like that. But hopefully that shouldn't take you too long. I've seen them all across the spectrum, right? I see people that are super organized and have a whole book that they bring in, and I see other folks that are $50,000 or $60,000 off on their balances in their different investment accounts. So.
Yeah, good enough. Well, I know, my 20s and 30s, I was very involved in every penny. And then in my 40s, I have gotten more kind of just let it go. You and I have kind of come up with a plan, and I just kind of let that plan ride and set it automatic and just let it roll. And that's been a good plan for me, and get those statements quarterly. And I've always, for me personally, I just enjoy looking at those statements. I put them away and I say, money's in good hands, and we're in good shape. So even in a downturn market like it had been over the last couple of years, I always looked at that as a buying opportunity whenever those are out there. So it's when you look at it that way, downturn in market is not a bad thing. You're like, hey, everything's on sale. I really enjoy it. So that's been my own personal story in that. And so, Andrew, thanks for your work and all that you do. I'll remind folks that if they're new to podcasting and they're looking for an easy way, speaking of easy, if you're looking for an easy way to listen to podcasts, consider using Stitcher, available on any browser as well as both Android and iPhone platforms. And it's a great way to listen to podcasts at home and on the road. Really good on the road. You can just plug that thing in and plug it into your car stereo and listen it right through there. This show and all the past shows are on Stitcher. Stitcher.com, search Financial Tech. It's education for your ears. And be sure to visit Guide Rock Capital at guiderockcapital.com. Follow Andrew on Twitter. He is just Andrew D. Hunt. Get all the show notes to this show if you want to go back and read the written commentary at theaverageguy.tv. This would be theaverageguy.tv/HT. And as soon as I started that, Andrew, I thought I have no idea what number this is. I should have looked that up in advance, but go out to theaverageguy.tv and you will find the most recent Financial Tech. There's actually a drop down on the top of navigation. It'll say tag podcast, drop that down, Financial Tech, and they'll all show up in order for you. So a good thing to do anyways. Now, Andrew and I say thanks for listening. We'll catch up to you next week. Remember, be smart about your investing. GuideRock Capital Management, Inc., or GuideRock, is a registered investment advisor that is registered with the state of Nebraska and located in Omaha, Nebraska. GuideRock and its representatives are in compliance with the current registration requirements imposed upon investment advisors in the states in which they maintain clients. GuideRock may only transact business in those states in which it is registered or qualifies for an exemption or exclusion from registration requirements. Important information describing GuideRock's business operations, services, and fees can be viewed on the SEC's website at www.advisorinfo.sec.gov. GuideRock will provide Form ADV Part 2, which serves as the firm's disclosure document to all clients. Copies of Form ADV Part 2 are also available to interested parties upon request. All investment strategies have the potential for profit or loss. Past performance is not indicative of future results. No current or prospective clients should assume that the future performance of any specific investment strategy, or product made reference to directly or indirectly on this video, website, or indirectly via hyperlink or any affiliated third-party website will be profitable or equal to past performance levels.